Yeah, and like, you get like
It's lined up.
that's why they go for like 30 grand.
You can do it.
Yeah, it's gonna have.
I'm thinking, I'm not working. Well, that's my monthly.
Okay, guys, we go ahead and get started.
Just have like 6
So now we're going to get into how to estimate bad debt, okay? And again, there's two methods, as we mentioned earlier. One will be based on sales, so it'll pay the accuracy of your income statement. And the other will be based on accounts receivable, fixed accuracy of your balance sheet. Both are acceptable. So, let's start out with the percentage of sales method. Okay? So what we're doing is we're estimating, that's the letter E, estimating bad debt. Of course, it's the expense. And we're going to start with the percentage of sales method. So, in this case, let's say there's $400,000 worth of sales. And again, your main concern is credit sales. Sometimes they don't tell you what the cash sales are, and sometimes they're so small that it's immaterial. But credit sales, of course, are accounts. And it says you estimate that 0.6%. Now, this is 0.6%, so don't forget 0.6% equals 0.006. So be sure to watch it, because sometimes they'll come out with a fraction of a percent. When you turn that into a decimal, don't forget that extra zero, because 0.6% is 0.006 in decimal form, right? So be sure to watch that, okay? So that means of these sales you expect, so this is the credit sales, this is your estimation of bad debt, this is your bad debt expense. Okay, now, you guys are pretty sharp. What do you think the journal entry will be? It's the allowance method. So what you're going to do is you're going to debit on December 31st, this is an adjusting entry. You're going to debit bad debt expense for the $2,400, and you're going to credit the allowance for doubtful accounts. For the $2,400, right? And so this is an adjusting entry. And so what you're doing is does that make sense? All right. All right. Now, you guys okay with that? So let's do this. Let's do exercise 9.4. You find that on page 382. So let's take a look. So 9.4, exercise 9.4, page 382. So it'll be in this page. Here's 9.4.
Does that say percentage?
Yeah.
Oh, okay, okay. This word here you mean?
Yeah.
That is percentage, yeah? All right. All right, so here's the problem. At year end, December 31st, the Alberta company estimates it has bad debts of 0.5%, so that's 0.005 is a decimal, right? On annual sales of $875,000. So what they do, they record their bad debt expense for that estimate. In the following February, it decides that 420 is uncollectible and writes off the bad debt. On June 5th, Cole unexpectedly pays, so you got to reinstate it. Okay, so what this does is it takes care of estimating the bad debt and then goes on to review the things that we just did. Are you guys okay with that? Okay. here's the estimation. And I know I'm repeating myself, but 0.5% is 0.005. Because somebody on the test is going to put that as point, you know what I mean? So I know I'm repeating myself, but trust me. There's a method to my madness. Okay, you guys okay with that? Now, here's the write-off, just as before. You debit the allowance and credit the accounts receivable. Here's the reinstatement. This is a two-step process. The first thing you do is reinstate the account by reversing the write-off, and then the second thing you do is you record the receipt of cash. I'm going to make sure that this thing's still recording today. Okay. Yep, doing just fine. Red dot. Okay. People are still taking notes. Now, most people are done, so I'm going to head and move this over to this overhead. If anybody still wants more time with it. And then, let's go ahead with the next part of this. So now, we just talked about the percentage of sales method, right? And it's based on sales. Now what we're going to do is we're having the one that's based on accounts receivable. Okay, so we're going to start with the percent of accounts receivable. So what you want to do is at the end of the year, again it's an adjusting entry, you take a look at the year-end accounts receivable, and you multiply it times the bad debt percent. So you take a look at your accounts receivable and you say, I estimate 5% or 0.005 or whatever percent this will prove to be uncollectible. And then, so step one is you estimate the amount of bad debt. And then what you do is you take the total, you take this amount, we'll call it the bad debt expense. So then the total is the total bad debt. Okay, and that's the one we figured here, minus the previous balance, minus the balance in the allowance. That will give us the current bad debt expense.
Minus the balance and the allowance.
In the allowance account, okay, right? Equals the current bad debt expense. So let me give you an example as to what we mean this. So what we're doing here, when we had the percentage of sales method as we did over here, we just multiplied the sales, the net credit sales, times the amount of bad debt in those sales. We did not take into account the current balance in the allowance, right? What we're doing now is we're taking that current balance into account. So let me show you and then maybe we'll discuss it. So in this case, in this particular business, there's $50,000 in accounts receivable, right? Okay. And there's a $200 credit balance. There's a $200 credit balance in the allowance. Okay, and we'll make the allowance for doubtful accounts. And I will write ACCT per account, okay? And you estimate that 5% of receivables, I'm gonna call it AR, will prove uncollectible. Okay? So,
Is it normal for numbers to go that much from 0.5 to 5?
they're independent. It's not a matter of a jump, they're just independent. And again, what you do on this thing is, there's a number of, first of all, a whole bunch of ways you can do, things that feed this. Often what happens is, you've been in business for a while, right? So you kind of have a baseline, and then you adjust that baseline for current economic conditions. So bad times, a lot of unemployment, you up it, okay? The other thing is, it all depends how you do business, because let's face it, some businesses extend easy credit, hope people get behind, make their money off the late penalties, and experience more bad debt than other businesses. So depends on, depends how you do business too. Kristen, am I answering your question?
Oh, I was just wondering, because all the other ones were like 0.5%, but this one we're doing like 5%. So I was wondering if the method had anything to do
Oh,
with the
no.
percentage change.
No. It's just that, this business experiences this amount of bad debt as a general rule.
Okay.
Okay? And they may just, okay, all right. And again, they're independent, so it's not a jump. Times 5%. So you estimate that 2,500, so here's your accounts receivable, and you estimate that 2,500 that will prove to be uncollectible. Now, what you do is, you take this 2,500, you subtract the 200 current balance, and you make an adjustment of 2,300. So what you do is, here's your target, here's your current, so here's the adjustment. So the adjustment of 2,300 will raise the current balance of 200 up to the 2,500, okay? And let me just write some more and then we'll have a chance to discuss it. So in this case, it's an adjusting entry, so it'll be December 31. You're going to debit bad debt expense for the 2,300, and you're going to credit the allowance for doubtful accounts, ACCT, for 2,300. Okay? So what you want to do is you want to bring it up to the target. So let me show you what we have here. So in this case, here's the allowance. For doubtful accounts. It currently has a balance of 200. You want a target of 2,500. And here's where you got that target. Okay? That means you need a $2,300 credit adjustment. And that 2,300 is the amount of bad debt you're incurring. Does that make sense? And one way, there's a couple ways, the reason it works this way is because the allowance for doubtful accounts is a permanent account, right? And so on the balance sheet, you'll have your accounts receivable minus the allowance to get the net realizable value, right? This is a permanent account. And so you want the balance in that account to be 2,500. So it's a permanent account, it's not a temporary account. And so, and again, it's a contra asset, it's a permanent account. A temporary account is like revenue and expenses, right? They're close to the end. This one is permanent. Its balance carries forward. And so it showed up with a balance of 200. You want a balance of 2,500 So this is the adjustment that will do that. And the reason it works this way is because this is a permanent account and you need to change it. So now your income, your balance sheet will have accounts receivable 5,000 minus allowance for doubtful accounts of 2,500. The difference will be your net realizable value. Does that make sense? And that's why it's done that way. It's because you're adjusting the balance in the permanent account. Okay? And it's the balance. Is everybody okay with that? Okay? Now, let's suppose instead of a $200 credit, what would have happened if it was a $200 debit? So now, let's go here. So again, it's the same account as the allowance for, I'm going to sit down because I think it makes my writing better, for doubtful accounts. Now it had a $200 debit. Here was a credit, now it's a debit, right? So this is the balance. Your targeting's again 2,500. Now the adjustment will be 2,700. And in this case, what you'll do is, that December 31st is an adjusting entry. You'll have bad debt expense. Will be debited for 2,700. And your allowance, and by the way, to move along, if I just write the word allowance, is everybody okay if I leave out for doubtful accounts in that? Okay, will be credited for 2,700. Okay? And of course, what happened here is, in the first case, when you had the credit balance, that means you overestimated and you didn't write off 200. What this means is that you wrote off all that you allowed for last year and $200 more. Okay? Does that make sense? So that's why you ended up with these balances at the end of the year. So here you didn't write off all that you allowed for. There's $200 still left in the pot. Here you wrote off all that you allowed for and $200 more. But in each case, there's a permanent account that needs this balance. So you make an adjustment that will change it to this, because then when it was on the balance sheet, so this is the balance sheet, under the asset section, you will have accounts receivable of $50,000 less the allowance of $2,500. That will be $47,500, and that will be the net realizable value. Okay? And it's because you want this to be the balance in this permanent account. And here's where it came in at. Here's where it has to be now. This is the amount that will bring it up to that. And again, your emphasis here is the balance sheet. Does that make sense? Everybody okay with that? All right. Let's do this then. Let's do exercise 9.5. And you find that on page 382. So here it is. It's this one right here. All right. So at each calendar year end, the Carroll Supply Company uses a percentage of accounts receivable method to estimate bad debt expense. I'll make it a little larger because it's easier to read. Okay. On December 31st, its outstanding accounts receivable is $53,000 and estimates that 4% will be uncollectible. Prepare the adjusting entry to record the bad debt expense for 2011 under the assumption that the allowance for doubtful accounts, in the first place, it has the credit of $915, and in the second instance, it has a debit of $1,332. Okay? So let me turn you loose with that. for the first one. So here's what you do. Now, in this case, what you do is, in this case, here's your accounts receivable. 4% will prove to be uncollectible, so this is the amount that you want as a credit balance. Currently, you have a credit balance of $915, therefore, the difference is the amount of adjustment. So $1,250 will bring this $915 up to the $2,120. Does that make sense? This guy does a pretty good job. This is not the best format in terms of giving you an answer. Would you like that in key counts or anything? You guys okay with that? So this is the design, this is your target, this is the current balance, this is the adjustment that will bring the current balance up to the target. Okay? That sound good? Cameron, I don't mean to put you on the spot. You got one more explanation?
Oh, no, that's fine. I just like, the percentage kind of screwed me up. Because
Okay.
I thought you said .004, but then.
Well, sure. So all I meant to say on that is, don't forget, often, for some reason in this textbook, you'll see it as 0.4% or 0.5%. And what people often do is when they calculate it, they forget that it's 0.1% and treat it as over a whole percent. So when you see 0.4%, don't forget, that's 0.0004.
Okay. That's what I was kind of
Yeah.
getting to. Okay, I didn't see the
Yeah.
missing point.
And then but in this case, there's no point, it's just 4%.
Alright.
So this is 0.04.
Okay.
Yeah, 0.004, it would be 0.4. Okay. And people just, it's an easy one to overlook. It's kind of unexpected. Okay, you guys, now the next one. In this case, now, you have a debit balance. So again, you have a sale target, right? 4% of the 53,000. Now, because you have a debit, this is the amount of the adjustment. So it's going to take $3,452 to change this debit of 1,332 to a credit of 2,120. So now this is the amount of the adjustment. And again, it's because this allowance is a permanent account, and you want to change the balance, so then when it goes onto the balance sheet, it will give you the correct net realizable value. It's because it's a permanent account, so the reason it's been done this way. All right, you guys doing good? All right, let's do this then. Let's go ahead and move on to the next one. So who's working with this? Can I see a show of hands? Anyone? Okay. All right. So now, when you, in this case, there's the most accurate way of figuring the accounts receivable is called aging of accounts receivable. Okay. So the way this works is, this is, I think this is number 8, I think. Something like that. I thought 8 would be in this right sequence, 8 and 7. So this is aging of accounts receivable. No, all right. So what you got here now? So what's happening here now is the fact that when you guys take a look at your accounts receivable, the older they are, the more likely there's an unresolvable problem, the less likely you are to collect. Okay, and it's just a matter of fact. So all of us could forget to pay a bill, right? And so the way that works, let's go back. So a certain percentage of those that are not yet due are going to prove to be uncollectible. A higher percentage of those that are past 32 to 30 days are going to be uncollectible. But when they get to be 6 or 8 months old, let's face it, the odds you collect that go down, 50%, whatever, right? And it's because if they're 6 months old, there's probably a real problem. There's a job problem, there's a dispute about owing the bill, something. So the older it is, So what you do on this thing is to estimate your bad debt expense, you age your accounts receivable. So let me kind of show you how this works. So, and by the way, this example, you can find it on page 368 of your textbook, and sometimes it's easier to look at the thing in front of you, okay? So in this case, you have your customer. So, now just let me walk you through this. So you have your customer, okay, and in this case, and then you have, here's the total accounts receivable for that customer. The next column is not yet due. The next column is 1 to 30 days past due. The next column is 31 to 60 past due. The next is 61 to 90 past due. And the next is over 90 days. Okay? So here we have Carly. She owes you a total of $450, and none of that is overdue. Okay? Now we have Jamie. Now Jamie owes you a total of $710, and all 710 of that is between 31 and 60 days past due. We have Chavez, and that person owes you $500. 300 is not yet due, and 200 is 1 to 30 days old. We have B-A-L-I-C-I-A, Belicia, okay? She owes you, he or she owes you $740, owes the company, owes you $740. $100, that is 60 to 190 days, and another is $640. There's a break in here, and it goes down to the very one at the end. So here we have Zamora, who's the last one. They're leaving out some in the middle here. This company owes you $1,000. 810 is not yet due. 190 is 1 to 30 days past due. So your total accounts receivable is $50,000. Okay? The total that's not yet due, we add this column up, is $37,000. Okay? We add this up, we add this up, so the total between 1 and 30 days is 6,500. So don't forget, some are missing here, right? The total 31 to 60 is 3,700. The total 61 to 90 is 1,900. And the total over 90 is 900. Okay? All right. So I'm going to put a line above it because we're adding above it. All right. Now, in the past, 2% of those not yet due have proven to be uncollectible. And 2% of this comes to 740. 5% of those that are between 1 and 30 days past due have proven to be uncollectible, and this is 325. Sure. Okay? And then 10% of those that are between 31 and 60 have proven to be uncollectible in the past. Then it jumps up to 25% if they're 61 to 90, so that's 475. And those that are over 90, you've only 40% have proven to be uncollectible. And I think the number would probably be higher than this if it's over 90, but okay. So what you're saying here now is the fact that the older your accounts receivable is, the less likely you are to collect it. And it's going to make sense because anybody can forget to pay a bill, right? But when it's 60 or when it's 90 or more, it indicates there's some real problem, a job issue, or there may be a dispute about what they actually owe it, etc. So you add all of these up, and that equals 2,270. And so this is the amount of your bad debt. This is the amount of your bad debt expense. Let's say the current balance in your allowance account is, let's say it's 0, okay? Or actually, no, let's say it's 200. So now the current balance is 200, okay? So let me make sure I got it. It's 2,270. So let's say 200 is so this is your target. this is your current balance. That means your adjustment will be 2,070. And this is a credit. Okay? And so what you do with that, of course, is you're going to debit bad debt expense. So it's December 31, because it's an adjusting entry. You're going to debit bad debt expense for 2070, and you're going to credit the allowance 2070. Okay, does that make sense? So to kind of sum up, one way you can estimate your bad debt expense, and you're looking at your accounts receivable, you have $50,000 in accounts receivable. How much of that is bad debt? In business, the older an accounts receivable is, the less likely you are to collect it. So you divide it up into these columns, and then this is your total, this is the total amount of bad debt you have in that accounts receivable. Because it's based on the balance sheet, you want to change your current balance from what it is to your target. So in this case, if it's 200, an adjustment of 2,070 will bring it from this to that, and that's the amount of the adjustment. And this is a method to estimate the bad debt in your accounts receivable. Is everybody doing good on that? All right. If your eyes are okay with that, let's do this. Let's do, see, what do we got here? Let's do this. Let's do exercise 9.6. You find that on page 382, 383. Here's how it reads. Okay, so here's 382. So what it says is, the Hector Company estimates uncollectible accounts using the allowance method December 31st to prepare the following aging of accounts receivable. So they have a total of 190,000 accounts receivable. 132,000 is not yet due, and in the past, 1% of that has proven to be uncollectible. 30,000 is 1 to 30 past due, and in the past 2% of that has been collectible, and so the amount uncollectible goes up to over 90, 12% is proven to be uncollectible. Okay? So then, on the next page, what it says is, it'll be on the back of this thing. So then on the next page, what it says is, no it isn't. Let's see, well that's right, yeah. So here's the first page. Now let me look to 283. Here it is. So now what they want you to do with this is they want you to so estimate the balance of the allowance of doubtful accounts using the aging of accounts receivable method. This will be the balance, this 2,270. Prepare the adjusting entry and assume there was a $600 credit existing in the allowance or a $400 debit. Okay, I'll put both of those up there. Does that make sense? So first of all, how much bad debt is going to be in these accounts receivable? And then do the adjustment if there's a $600 credit in the allowance for doubtful accounts, and then if there's a $400 debit. Is everybody okay with that? All right. So, is this what you guys got for a target? That sound about right? So here's 1% of the not yet due, 2% of the 1 to 30, 4% of the 31 to 60, and so forth, add them up. So that's your target, right? And then do the adjusting entry if there's a $600 credit, and do it a second time if there's a $400 debit. So is this what you guys got when there was a $600 credit? So this adjustment will bring it from the balance of 600 up to the target of 4,020. Does that sound about right? All right, and this is what it's like when you have the debit balance. So now, okay, so now, again, you have the same target, but now because there's a debit balance, it'll take 4,420 to bring the current debit up to this credit. Okay? That sound good? Sound good? All right. All right, you guys doing good? All right, let me check with you guys. Who's working with this? All right, let's do this. Now, let's have a summary and then a review. Okay, before I do this, what questions are there, any? All right, here's the summary. So, in this case, by the way, you can find this in page 369 of your textbook. It's easier to read. Okay. So in this case, it's bad debt estimation. So, one, the percentage of sales method focuses on the income statement, and what it is the sales times the rate of bad debt to get the bad debt expense, and you do not take into account the current balance, right? Then the other focuses on the balance sheet, and it's either the percentage of receivables or the aging of the receivables. And so both, it's your balance sheet, they want you to calculate the net realizable value. It takes the allowance for doubtful accounts, which is a permanent account, and it adjusts it to match the target. So in this case, it's a percentage of receivable methods, it's the accounts receivable times the rate, okay? That will go to the allowance for doubtful accounts. Under the aging of receivables, it's the aging of receivables by age times rates by age for the allowance for doubtful accounts. And this is the first time I use this overhead. I won't use it again because it seems to me they should. And then adjust, because don't forget on these two, you need to adjust so that the adjustment brings the current balance up to the target. They should have included that. Okay, does that make sense? And I just won't use this again. Courtney, how you doing down there? Just that kind of quizzical look. I didn't put you on the spot. You got a question? All right. You guys doing good? All right, let's have a review. Okay. So, this is, today's what, this 18th? No, all right, so this is fall 2002013, and this is 201, this is Tuesday, right? So you're 201 Delta. Okay. All right, so let's have a review. So, here's where we started out. We started out with just a review of credit sales. And so essentially so what it boils down to, your customers have to be able to buy something, right? And so one way you can enable them to buy it is to take credit sales. So a credit sale looks like this. In this case, there was a sale of $950. The cost of the goods you sold was $800, and you collected $720. So because it's perpetual, you debit accounts receivable and credit sales for the amount of the revenue. You update the expense by debiting cost of goods sold and crediting inventory. In other words, you convert this asset into that expense. Then you record the receipt of cash, you debit cash and credit accounts receivable. Now what many companies do is they simply accept credit cards. And that way, they shift the burden onto the credit card company. Of course, there's a fee for that. So in this case, there's a $100 sale, a 4% credit charge, a credit card charge. So 4% of $100 is $4, 100 minus 4 is 96. So if it is one of those where they swipe the card electronically and the money's transferred into the merchant's accounts instantaneously, it's considered a credit sale. And so $96 is a debit to cash, $4 is a debit to credit card expense, and it was a $100 sale. Now, you also sometimes see where what they'll do is they'll take your credit card and they will fill out the little slips, like 3 by 8, I suppose it is, and the machine. Then they mail those in and get reimbursed. If that happens, then it's a two-step process. You record the sale, but now you debit accounts receivable instead of cash. Debit credit card expenses you did before and credit sales you did before. Then when you receive the cash, you debit cash and credit accounts receivable. Okay? Now, the next thing we talked about is the fact that, so there's two ways to allow for bad debt. One is the direct write-off and the other is allowance method. And we started with the direct write-off method. And the direct write-off method is you have extended credit and now the person goes bankrupt or whatever. This is that J. Kent again. So J. Kent sends you a letter, says, I've gone bankrupt, you're out of luck, you write it off. And so what you do is you debit bad debt expense and you credit accounts receivable. Okay? And now, J. Kent says, I won the lottery, I'm going to make good on some of my debt, here's a check for $520. So recovering bad debt is a two-step process. Step 1 reestablishes the account by reversing the write-off, and step 2 records the receipt of cash. So here you're reestablishing the account by debiting accounts receivable and crediting bad debts, you reverse the write-off, and then here you record the receipt of cash. And of course, step 2 doesn't make any sense without step 1. Okay? Now the trouble with the direct write-off method is that most of the time it screws up the matching principle. You extended credit to increase sales. Extending credit, it almost always includes bad debt expense. So you want the expense of extending credit to fall in the same accounting period as the actual sale. With a direct write-off method, the sale was probably the last accounting period, but you're writing it off in this accounting period, and so the expenses and the revenue don't match. Sometimes you have to do this simply because you can't estimate bad debt because you don't expect any bad debt because you have really tight credit policies, right? And when somebody reneges on their account, you're honestly surprised, okay? The other thing is the IRS will only accept the direct write-off method. They don't accept the allowance method, okay? Now, the next way of doing it is the allowance method. By the way, we covered a lot of material today, didn't we? It's kind of impressive. All right. Anyway, next is the allowance method. Now, with the allowance method, the object of this whole thing is you want the bad debt expense to have to be in the same accounting period as the sale. So what you do an adjusting entry and you estimate the amount of bad debt that you will incur. So sometimes it would be based on the sale, on sales, that favors the accuracy of your income statement, and sometimes it'll be based on accounts receivable that favors the accuracy of your balance sheet. Okay, so in this case, what it is there's $300,000 worth of sales, you have $20,000 in accounts receivable, and you estimate to $1,500 this accounts receivable beyond collectible. So what you do is bad debt expense is debited for that $1,500, and allowance for doubtful accounts is credited for $1,500. This allowance for doubtful accounts is a contra asset account. Here's what it looks like in T accounts. So here you have a debit